Imagine knowing the secrets of a man who predicted the 2008 financial crisis and turned it into a fortune. Michael Burry, the legendary investor immortalized in The Big Short, is back with bold new moves in the stock market. What could he possibly be seeing that others don't? Brace yourself as we dive into his latest 13F filing to uncover the secrets of his portfolio and what it might mean for the rest of us. First off, for those of you who might be new here or need a quick refresher, Michael Burry is the genius who predicted the 2008 housing crash. His story was so captivating, it became a movie called The Big Short. Now, Burry is known for his sharp, often contrarian investment strategies. And when he makes a move, the financial world pays attention. Burry just released his latest 13F filing. This document is like a peek behind the curtain, showing us what stocks he's buying and selling. Usually, Burry's moves can seem all over the place from one quarter to the next, making it tricky to pin down a clear strategy. But this time, two strong themes have emerged, giving us a bit more to chew on. Inflation. Remember when we thought we were getting inflation under control? Well, Burry seems to think otherwise. He's betting big on another wave of inflation hitting us in 2024. Why? Burry believes that the economic measures taken to curb the initial wave of inflation might not be enough, and we could be in for a second round. And if history has taught us anything, it's that when Burry makes a prediction, it's wise to listen. Now, digging into the specifics, Burry's portfolio shows some interesting shifts. He's heavily investing in commodities and companies that tend to perform well during inflationary periods. Think of sectors like energy, agriculture, and basic materials. These are the industries that can pass on higher costs to consumers, making them a safer bet when prices are rising across the board. One standout move is Burry's increased stake in oil and gas companies. With the global energy landscape being as volatile as it is, and with supply chain issues still making headlines, this move suggests he's anticipating higher energy prices. And higher energy prices often signal broader inflationary trends. But that's not all. Burry is also eyeing agricultural stocks. Why? Because food prices are a major component of inflation. As the world grapples with climate change and supply chain disruptions, agricultural commodities are likely to see price hikes. Burry's bet here is that these stocks will benefit as food costs soar. Now, let's address the elephant in the room. Is Burry's predictions something we should all be worried about? Well, he's been right before, and his track record speaks volumes. But it's also important to note that the market is unpredictable. While Burry is positioning himself for what he sees as an inevitable second wave of inflation, we need to consider other factors too, like potential government interventions and global economic shifts. So, what does this mean for the average investor? Should we all start buying up commodities and energy stocks? Not necessarily. While it's intriguing to follow Burry's moves, it's crucial to do your own research and understand your own risk tolerance. Diversification is key, and jumping on trends without a solid plan can be risky. Now onto the specifics of his recent activity. Burry has been doing a lot of chopping and changing in his portfolio. He sold out of 14 stocks, including big names like Google, Amazon, and Oracle. At the same time, he added to 11 positions and bought 5 new stocks entirely. Here's where it gets really interesting. One of these new additions is the Sprott Physical Gold Trust. In Q1, Burry bought over 440,000 shares, making up 7.37% of his US portfolio. Now, you might wonder why he's buying into gold when prices are already high. Well, gold is a classic hedge against economic uncertainty and inflation, two things Burry is very concerned about. Sprott Physical Gold Trust is a closed-end fund that holds assets in physical gold bullion. With gold prices at near all-time highs, this move might seem odd for a value-minded investor like Burry. However, gold is a safe haven during times of economic instability and market volatility, something Burry has been vocal about. His investment in Sprott aligns perfectly with his long-standing concerns about economic conditions. Now, Historically, gold has been a go-to asset during economic uncertainty. Its price spiked during the Great Depression, skyrocketed in the 70s, for reasons we'll discuss shortly, and surged after the tech bubble burst, the 2008 financial crisis, and more recently during the COVID-19 pandemic. While much of gold's appeal is psychologically driven, the trend is undeniable, and Burry is banking on this uptrend continuing since October last year. With all that's happening globally, from tariffs and elections to wars, supply chain disruptions, and rising inflation, gold is an attractive hedge. Beyond economic downturns, investors flock to gold for its stability. It's a similar story to why Burry is increasing his positions in commodities and agricultural stocks. In summary, Michael Burry is back and making bold predictions once again. His latest 13F filing reveals a clear strategy aimed at preparing for a second wave of inflation in 2024. By investing heavily in commodities and industries that thrive in inflationary times, Burry is positioning himself to potentially profit from what he sees as an inevitable economic shift. Michael Burry has a significant investment in JD.com, which is the largest stock in his US portfolio. This investment is worth approximately $99,986 million. However, considering his estimated total fund size of $238 million, JD.com represents just about 4% of his overall portfolio. While this is a substantial investment, it is not overwhelming in the context of his entire fund. More interestingly, Burry appears to take a cautious approach to investing. It is estimated that around 52% of his portfolio is allocated to US Treasuries. This large allocation suggests that Burry is being careful amid the current market volatility, preferring the relative safety of government bonds over more volatile equities. It's important to understand that the information about Burry's investments comes from 13F filings. These filings provide a snapshot of his US portfolio at a specific point in time, but they have limitations. For one, they only cover his investments in the United States, meaning any international investments he holds are not included. Therefore, the 13F filings do not give a complete picture of Burry's entire investment strategy. In addition to the limitations of the 13F filings, these documents only show what Burry held at the end of the reporting period. They do not account for any changes made shortly before or after the filing. Given these factors, it's essential to consider the broader context when analyzing Burry's investments. His significant holding in JD.com and the substantial allocation to US Treasuries indicate a balanced strategy. On one hand, he is investing in a major Chinese company, reflecting confidence in its growth potential. On the other hand, his large investment in US Treasuries shows a preference for stability and caution, likely as a hedge against market uncertainty. Thanks for watching. Please like the video, press the subscribe button, and also drop your thoughts in the comments section.
If I ask you this question, who is currently the most powerful tech CEO in the world, I'm pretty sure your answer would either be Elon Musk, Mark Zuckerberg, or Jeff Bezos. Or you might even say Sundar Pichai, the CEO of Google. But sorry folks, your answer would be wrong. Sure, each of these guys has taken a turn at being the alpha dog in the tech industry, but none of them can claim this title right now. So, who is he? In this video, we'll reveal to you the new tech CEO currently ruling the tech world quietly. I know it's a bit shocking that Elon Musk, Jeff Bezos, and Mark Zuckerberg have been pushed out of the helm of leadership in the tech world, but if you think about it, it does make some sense. I mean, Musk is now a polarizing figure. Zuckerberg sold the world a social media dream that, frankly speaking, has turned into a nightmare, and Jeff Bezos ejected himself from being Amazon CEO simply because he has a new dream of making rockets, and he also wants to frolic around with his fiancée on his yacht. But if that's what makes him happy, good for him. Anyway, the point is that at the beginning of 2023 there was a vacancy in who would claim the title of boss of the tech world, and when ChatGPT was released, it seemed Sam Altman, the CEO of OpenAI, might claim the title. But he didn't, because he hasn't been in the game for a long time. However, the AI boom of 2023 has brought a new guy to the head of the tech table, and he did it without the usual fanfare. You can even say that he slipped into the ranks. This man is none other than the CEO of tech company Nvidia, Jensen Huang, and yes, he is the new boss in town. Jensen Huang has never been among the top 5 richest people in the world like Elon, nor is he a household name like Bezos or Zuckerberg, but his company Nvidia currently beats Tesla, Facebook and Amazon by far in terms of valuation, earning him a place in the trillion-dollar club, a club with only 6 members whose companies are all valued above the trillion-dollar mark. And the reason for all this is that Huang is a patient monopolist who saw the future of artificial intelligence 10 years ago, took advantage of it, and is currently reaping the rewards. But first, how did it all start? Jensen Huang was born in 1963 in Taipei, Taiwan, where he spent the first 10 years of his life. However, in 1973, Huang's parents decided to send Huang and his brother to live with their aunt and uncle in the US due to the social unrest in Southeast Asia at the time, before relocating to the US themselves. According to Huang's 2002 interview with Wired, this period was an interesting time in his life because his aunt and uncle, who were also immigrants, mistakenly sent Jensen and his brother to Oneida Baptist Institute in Kentucky, a reform school instead of a prep school. Although the kids were tough, sometimes entering into fights with pocket knives, Huang admitted he loved it there. Eventually, Huang and his brother moved on to Oregon to join their parents, where he graduated from Aloha High School. In 1984, Jensen received his first degree in electrical engineering from Oregon State University, and according to him, that was the perfect year to graduate because the first Mac computers had just been released, ushering in a new era in personal computing. After graduation, Huang worked in a variety of roles at LSI Logic and Advanced Micro Devices, both of which were chip companies soon after he bagged a master's degree in electrical engineering from Stanford University in 1992 and left LSI to build Nvidia. At 30 years old, Huang drafted the paperwork for Nvidia with 2 of his friends, Chris Malachowski and Curtis Priem, at Denny's restaurant in San Jose, California, in 1993. It was the same restaurant where Huang worked part-time when he was still a student, and the introverted and shy Huang learned how to be more outgoing. The idea was to create a company that built graphic chips for personal computers, which was quite fantastic, but the process of getting funding was not easy, so for the next 6 months, the 3 friends gathered together and did nothing except talk and have lunch. Eventually, the company was incorporated with $200 each, giving them a 20% stake in the company. The company's main product is its graphics processing unit, also called a GPU, a circuit with a powerful microchip at its core. When Nvidia first started, the company only sold these GPUs to video gaming companies, and everything was going well, at least as well as it could for a small startup until the year 1997, when the company almost went broke. At the time, Nvidia was working on an order from Sega, a key player in the gaming industry, to build graphics chips for its gaming console. However, Microsoft unveiled a new texture mapping approach that would make Nvidia's product incompatible with Windows 95. This was a blow to the company because it was barely surviving and needed the money from Sega to keep floating. But Microsoft's announcement meant that it had to go broke instantly by stopping production of the card, or go broke later by building an inferior product that wouldn't bring much sales. However, Huang refused to give up, and he thought about a third option, which was calling the CEO of Sega to tell him Nvidia would no longer work on the order, and humbly requested full payment, which didn't even make sense. But somehow Huang did just that, and surprisingly it worked. Sega paid in full even though Nvidia didn't fulfill its part, and according to Huang, he still doesn't know why the CEO of Sega agreed. But whatever the reason, that payment was enough to sustain the company for the next 6 months. 2 years later, in 1999, the year Nvidia went public, the company unleashed the GeForce 256, a graphics processing unit that not only opened new possibilities for the tech world, but also placed Nvidia on a path to greatness. Nvidia's GPUs did not just revolutionize the gaming world, they also changed the game for computer-aided designs, mobile devices, and scientific computing, which Huang began to market in 2006. Then came 2013. 2017, when Huang, based on promising research from the computer scientific community, decided to bet Nvidia's future on artificial intelligence, which had disappointed investors for decades. Brian Catanzaro, the lead researcher for deep learning at Nvidia, later stated that he had doubts at the time, but 10 years later, Huang's bet had paid off. 2023, the year of artificial intelligence, unlocked the vast potential of Nvidia's GPUs for powering AI software. And as every tech company is jumping into the AI revolution, Nvidia is right in the middle of it. One Wall Street analyst put it like this: "There's a war going on out there in AI, but there's only one arms dealer, Nvidia." What this means is that instead of manufacturing chatbots or any AI products such as Tesla's self-driving cars, Nvidia produces the chips that make these AI products possible. And since AI is here to stay, Nvidia is not going anywhere either. It's no wonder that when it was revealed that the game-changing ChatGPT chatbot was trained on an Nvidia supercomputer, it spurred the largest single-day gains in stock market history. In June 2023, the company hit the $1 trillion market capitalization mark, making it the 6th most valuable company in the world. However, 9 months later in March 2024, Nvidia took the tech world by surprise by hitting and surpassing the $2 trillion market capitalization, thereby beating Amazon to become the 3rd most valuable US publicly traded company. And the amazing thing is that it's showing no sign of stopping. This gain is also translated into the net worth of Jensen Huang, which soared to $81 billion, making him the 20th richest person in the world. So Jensen Huang may not be the richest guy in the world with a company whose product is a household name, but his foresight into the AI revolution has certainly paved the way for him to be the most powerful tech CEO in the world. At least for now, until someone else rises to claim that title. What do you think about Jensen Huang? Do let us know in the comment section below, and remember to like, subscribe to, and share this video.
Millennials, a different approach to spending. Hello, friends. Today, we're diving into the spending habits of millennials, the generation often associated with avocado toast and overpriced lattes, while also being critiqued for their struggles with homeownership and retirement savings. But here's the truth. The reality behind millennial spending is much more nuanced and complex than the stereotypes suggest. Millennials are often misunderstood when it comes to their money management. They face economic challenges that previous generations didn't, and their priorities reflect a shift in values shaped by these circumstances. Before we dive deeper, take a moment and think about your own spending habits. What drives your financial decisions? Necessity, personal values, or perhaps societal pressure? Understanding millennial spending habits. Millennials aren't just spending impulsively. In fact, 2 primary factors explain how they spend their money differently from previous generations. Economic landscape. Millennials are navigating an economic environment where the cost of living has skyrocketed while wages have stagnated. Housing prices, student loan debt, and healthcare costs are through the roof, leaving millennials to adjust their financial approach. A shift in values. Millennials have learned from the mistakes of older generations. Instead of accumulating material wealth, they tend to prioritize experiences, personal development, and relationships. Research such as Harvard's study on adult development shows that meaningful relationships, experiences, and helping others are the true keys to long-term happiness. Let's explore 15 common expenses that millennials often face criticism for, but which can actually be smart investments in their overall well-being and happiness. Experiences over material goods. Millennials prioritize experiences over material goods. They want to enjoy life now, not just wait for retirement to travel or take time off. Whether it's spontaneous weekend trips or backpacking across Europe, millennials value the memories they create today. Think about it for a second. When was the last time a material item gave you long-term joy compared to a memorable experience with friends or family? Investing in personal aesthetics. Millennials are willing to spend more on fashion, skincare, and home decor. And it's not just about looking good. It's about feeling good. Personal aesthetics have a direct impact on their mental well-being. When they feel good in their environment, they tend to be more productive and satisfied with life. This generation understands the psychological benefits of self-presentation and the power of creating an inspiring personal space, pursuing meaningful ventures. Instead of waiting until retirement to pursue their passions, millennials are doing it now. Whether it's restoring classic cars or starting creative side hustles, millennials invest time and money into what they love early on. The idea is simple. Why wait to pursue happiness? If you have a passion project, wouldn't you want to start it sooner rather than later? Spending on status-enhancing experiences. Purchases like the latest smartphone, designer clothes, or dining at upscale restaurants aren't just about immediate gratification. They also play a role in social positioning. Projecting an image of success can open doors, build connections, and create opportunities that might otherwise be missed. Millennials understand that sometimes image is a form of currency in itself. Think about your own social circle. How often do you notice that certain purchases or experiences boost your confidence or help you make valuable connections? Investing in digital privacy and security. In an increasingly digital world, millennials prioritize their online safety. They're willing to pay for services like VPNs, encrypted messaging, or identity theft protection. For them, digital privacy isn't a luxury. It's a necessity in an era of data breaches and cyber threats. Peace of mind in the digital world is something millennials see as worth every penny. Viewing food as an experience. For millennials, food isn't just about nourishment. It's about connection. Whether it's trying out new cuisines, dining at trendy restaurants, or hosting potlucks, millennials find joy in shared meals. These experiences foster relationships and create memories, making food-related spending feel like an investment in their social well-being. When was the last time a shared meal brought you closer to someone or left a lasting memory? Spending on self-improvement. The self-help and personal development industry has exploded, and millennials are its biggest customers. Whether it's attending workshops, buying motivational books, or enrolling in online courses, they believe in investing in themselves. After all, why not spend on things that make you smarter, more fulfilled, and more successful in the long run? Investing in memorable weddings. Millennials often allocate significant budgets to their weddings, opting for destination celebrations or personalized, elaborate events. Why? Because they view weddings as a chance to create lasting memories with their loved ones. For many, the focus is on making the experience unforgettable rather than sticking to tradition. Indulging in expensive hobbies, from fitness classes to creative hobbies, millennials love trying new things. While their hobbies can sometimes be expensive, they offer physical, social, and mental benefits. Investing in themselves in this way provides them with balance and growth. If you could pick up a new hobby today, what would it be? And would you see it as an investment in yourself? Choosing sustainable brands. More and more, millennials opt for sustainable brands, even if they come with a higher price tag. They want to align their spending with their values, prioritizing environmental and ethical responsibility. Millennials are willing to spend more today to ensure a better tomorrow for the planet. Enjoying small daily treats. Whether it's that daily coffee or a mid-afternoon snack, millennials aren't afraid to indulge in small daily treats. These minor expenditures add a sense of joy and balance to a fast-paced life. Critics might argue that these are unnecessary expenses, but for millennials, it's about managing stress and maintaining a sense of groundedness. Prioritizing mental health and therapy. Unlike previous generations, millennials are more open about mental health and are willing to invest in therapy and wellness services. They see the long-term benefits of addressing emotional challenges early on, recognizing that mental health is just as important as physical health. Joining premium gyms. Millennials often choose gyms that offer more than just exercise. They seek community and connections. Premium gyms that also provide networking opportunities, wellness classes, and social spaces become worth the investment. Paying for convenient services like meal delivery, grocery shopping apps, or home cleaning services are essential time savers for busy millennials. They recognize that time is their most valuable resource, and outsourcing mundane tasks allows them to focus on their careers, personal development, or passions. Seeking peace of mind. Finally, millennials invest in things that give them peace of mind: health insurance, pet care, or life insurance. Knowing their loved ones and pets are taken care of allows them to focus on their goals without the constant worry of what if, renting versus buying. Let's also talk about home ownership. While many millennials still choose to rent, it's not just because they're avoiding responsibility. Rising real estate prices, combined with a desire for flexibility, make renting the smarter option for many. Millennials are more strategic in saving for homes in affordable areas, rather than rushing into the market. Millennials may be criticized for their spending habits, but in reality, they prioritize what truly matters to them: experiences, self-improvement, and overall well-being. Their financial decisions aren't reckless. They're intentional, reflecting a shift in values that emphasize happiness and fulfillment over material accumulation. So the next time you see a millennial spending on something that seems unnecessary, remember that their choices are often investments in a meaningful, balanced life. How about you? What do you prioritize when it comes to spending? Let me know in the comments. Bye for now.